according to reporting from Housing Wire, Unison, a San Francisco-based fintech company that offers home equity investments, is now facing a new class action lawsuit in California over the structure and marketing of its home equity investment agreements. Now, this latest lawsuit alleges that those contracts function more like a mortgage with a significant debt repayment than the company's marketing suggests to the homeowner. And home equity investment products, which are often called HEIs, allow a homeowner to receive a lump sum of cash up front in exchange for giving the company a share of their home's future appreciation. And these agreements are frequently marketed as being debt-free and interest-free, and it positions them as an alternative to traditional home equity loans or HELOCs. Now, this complaint in the case tells a very, very different story. In one example that is cited in the lawsuit, it involves an 80-year-old homeowner who reportedly received about $97,000 from a home equity investment agreement with Unison. This was in 2017. The funds were used to help fund home repairs and medical expenses. 8 years later, the required repayment amount to settle the agreement, it had ballooned to nearly $375,000, a repayment that equates to an annual percentage rate of approximately 34%. Plaintiffs argue that these agreements are not simply equity partnerships, but rather function as a disguised mortgage loan with a balloon payment that avoids licensing, disclosure, and consumer protection requirements that we typically see with a traditional mortgage or even a reverse. Now, this is not the first time Unison's business model has come under fire. Consumer advocates and also state regulators have raised similar concerns in other cases, and they argue that some home equity investment contracts behave much like loans because the homeowner receives upfront funds, which are secured by their property, but then later they must repay a larger amount tied to the home's value. Some legal challenges have even attempted to categorize or to regulate these products as reverse mortgages under certain state laws. And that is where the conversation really becomes especially important for our industry and reverse mortgage pros. When state regulators are looking to regulate home equity investment contracts as a reverse mortgage, then it unfairly associates the HECM and reverses with an arrangement that many are now increasingly seeing as nothing more than a predatory loan. And that's not only inaccurate, but it further undermines the credibility of the home equity conversion mortgage, which has more consumer safeguards than any other mortgage in the country. Unlike home equity investments, the HECM requires standardized disclosures, federal oversight, required third-party counseling, and also consumer safeguards designed specifically to protect older homeowners. Equity investment contracts have none of those guardrails. So when critics or legal filings loosely describe these arrangements that should be regulated as a reverse, it can unintentionally create confusion in the marketplace and also unfairly cast a shadow over the home equity conversion mortgage program. And considering the nearly 45% run-up in home values in the last 6 years, it's not surprising to see the rise of creative financing options, such as home equity investments. As courts and regulators continue to evaluate these particular agreements, the broader question may become how emerging home equity products should be classified, regulated, and also explained to consumers. In this segment, we bring you our exclusive interview with Mark O'Neill, Senior Vice President of Wholesale Lending at Mutual of Omaha Mortgage, and we spoke with him about the new sponsorship they have of a certification for traditional mortgage originators, which brings them the education and the basic terminology that's needed to understand the home equity conversion mortgage. So here is that interview we recorded just last week. Mark, thanks so much for joining us.
It's a pleasure. Thank you for having me.
So what led Mutual of Omaha to be the exclusive sponsor of the National Association of Mortgage Brokers Certified Reverse Mortgage Specialist Certification Program? Can you tell us just a little bit about that?
Yeah, sure. Happy to, Shannon. So the certification is not new. It has been around for about 3 years at this point. And the opportunity came up this year to pick up the sponsorship. Mm-hmm. And for us, we took a look at it and we said, this is a no-brainer. NAMB, National Association of Mortgage Brokers, who I think most of us are familiar with, represents close to 40,000 broker businesses in this country, hundreds of thousands of loan officers. So, it was a great opportunity, we thought, to not only get in front of all of those, brokers and originators to, spread the word about our reverse mortgage programs, but to also help to better educate the originators who are out there making the reverse mortgage loans.
These certifications and the foundational knowledge they're going to provide are going to be key, especially when engaging these traditional or forward mortgage brokers and originators, especially now that they're looking for new avenues of business. So how do you anticipate that this certification is going to be received by NAMB members?
Yeah, well, we're hopeful that it'll be received well. Of course, we're still very early in our sponsorship. Our first session is coming up in early April, and that will be the real test, right? We're hoping that there'll be at least several hundred participants signing up, and over the course of the year, as this program is delivered several times, we're hoping that thousands of originators will sign on and will show up. Time will tell. One would think that with all of the improvements in the program and the explosive growth we've seen, especially with proprietary jumbo reverse mortgages, there'll be more interest than ever. Time will tell. Maybe we can check back in a couple of months and see how we did.
Mark, what skill set do you hope that these originators and brokers who get the certification will gain?
Sure. So it's a what I would consider a basic level course. So the only prerequisite for participating would be to be a licensed originator. So we're expecting people will be in the sessions with the basic knowledge of how to originate a loan, but beyond that, be relatively new, if not brand new, to reverse mortgage. So the course itself, it's an all-day course. It's rather extensive. It takes you from everything from reverse mortgage basics, terminology, how principal limits work, counseling. Goes into a little more detail on some of the various ways that we help people, whether it be through a refinance or touches on HECM for purchase. Goes into some sales skills. So it's a rather comprehensive day of study, and it is a full day. But at the end of that, you're talking about producing originators who are armed with the basics and the ability to go out and speak intelligently to prospective borrowers at that point. We're not making people into specialists in 8 hours, right? In 7 or 8 hours. That would be well beyond the scope of this program. But by the end, we hope to be able to take, and the expectation is that we'd be able to take a licensed originator and at least make them conversant and at least have the ability to speak intelligently and make an informed presentation to a prospective borrower.
Are these courses offered online, in person, or both?
Yeah, good question. So the both, right? So we're delivering the first course is on April 2nd. That's going to be online and through the NAMB portal. But then there'll be additional sessions throughout the course of the year. We do know that it's a ways off, but in October during the NAMB National Conference in Las Vegas, we will be delivering the content in person. But between now and then, there'll most likely be additional online sessions after April 2nd.
Well, we do hope that you have a packed room in Las Vegas at the conference.
We're looking forward to that.
For those traditional mortgage professionals who do get the certification, how is Mutual of Omaha going to support them with tools and resources?
We would hope that this would just be, an entry point for those who want to, have an interest and want to become more conversant in reverse mortgage. As I mentioned, we're not going to make people experts. We're not going to make people, they're not going to learn the whole program on day one. We're really hoping to just whet the appetite and get them interested in learning more. So from the point that they participate in this program, they're going to be, tested out at the end of the day. And, if they pass the test, they're going to be able to carry that CREV designation. But beyond that, we're supporting our brokers with a whole host of additional training resources. We've got live trainings going on nearly every day of the week. We've got a whole library of pre-recorded sessions on everything from basics to more specialized classes for clients of ours who have the desire to train their team on a specific syllabus, if you will, or course of study. We've got learning management platform that we can plug those clients into. So if you've got a sales manager who wants to make sure that their entire team goes through a set course of study, we can set that up for them as well. So we're very supportive of education because we think that helps everybody, right? It helps our originators, be more informed and frankly, have better success selling in their markets. It certainly helps our senior borrowers with their experience. And we think it raises the bar for the whole industry and ultimately leads to better results, which will lead to more business for all of us. So we're hugely supportive of the training effort here at Mutual.
Mark, thank you for joining us. And if you do us a favor, check back in a couple months and give us an update on the certification and its reception. We'd love to hear from you.
Yeah, we'd love to. I'd really look forward to that, Shannon. Thank you.
Mortgage market analysts are now closely monitoring the potential impacts of the Iran war on mortgage rates. The conflict and the oil supply disruptions from the region have also influenced the 10-year constant maturity treasury yield, and that is, of course, a key benchmark which impacts the traditional and HECM mortgage rate. The 10-year constant maturity treasury rate, it plays a very direct role in just how much home equity a borrower can access through the federally insured home equity conversion mortgage, or HECM as we call it. And that's because the HECM's expected rate is tied in part to the 10-year treasury yield. And when that yield moves, even slightly, it can influence the principal limit factors that just determine how much equity the borrower can receive. Treasury yields moved higher as markets reacted to rising oil prices and the possibility that inflation could remain stubbornly elevated. The 10-year yield climbed noticeably during the first several days, trading days that is, as investors recalibrated their expectations. In other words, the bond market has been balancing two very different reactions on the same event. Again, on one side, rising energy prices, which are pushing up the expectation of sustained inflation, and of course that puts upward pressure on yields. But then on the other end, you have geopolitical uncertainty, which is driving investors toward the safety of U.S. Treasury bonds, and that is pulling yields lower. So for you as a reverse mortgage professional, those two competing forces do matter more than we may realize, because the expected rate on the HECM loan is tied directly to those treasury yields, and movements in the 10-year rate can ripple directly into the amount of equity that's available to a HECM applicant. The broader lesson here is that the events that appear completely unrelated to housing finance or reverse mortgage lending, they still influence our industry and the amount of available funds. And that is a reminder that the reverse mortgage industry does not operate in isolation from the rest of the global economy.